I want to dig deeper now into this morning's economic reports with Michael Gapen, Chief U.S. Economist at Barclays. Michael, good to see you here. So when you take a look at the economic numbers we've gotten over the past couple of days, retail sales came in disappointing yesterday, up 0.6%. The street was looking for about 1%. We've got this drop in housing starts and unemployment claims, remaining steady. Are economists a little too optimistic about this economic recovery?
Thank you for that question. Happy to be on with you today. I wouldn't say we're overly optimistic. It's just I think we all understand we're in a transition period. As you mentioned, the data had been pretty solid for quite some time. Households came out of lockdown with a lot of resources and willingness to spend. The good side of the economy rebounded very quickly. We're transitioning to a period where we're in essence satiated with goods right now. Pent-up demand has largely been filled. So going forward, further gains are going to have to come from the services side of the economy. That's likely to be much more uneven. And government transfer payments and the unemployment assistance as part of the CARES Act expired at the end of July. So we are seeing clear signs of a deceleration. I think the retail sales data suggest that's pretty clear right now. Downward revisions to July, negative on core retail sales for the month. And the industrial production data slowed further. So growth is definitely moderating. We did get some clear signs of that this week. I think it's mainly from this transition of goods back to services, as well as the expiration of fiscal stimulus and additional payments to households.
Michael, why are so many on the street this morning continuing to talk smack about what the Federal Reserve did yesterday? I didn't see any big surprise, but yet we're seeing the sell-off in the market here.
I don't know. I mean, I would reply that I think the Fed did what it told you it was going to do. It came a little sooner. We were debating on would you get all of it at this meeting, or would they kind of spread it out over 2 to 3 meetings perhaps. But the Fed got to where we all thought they would end up, outcome-based forward guidance tied to inflation and a signal that they'd be buying asset purchases for some time, and with a makeup strategy in place. And the funds rate is going to be near zero for the next 4 to 6 years, depending on the Fed's outlook. So I think maybe what spooked markets a little bit. It's obviously hard to talk about the market and what the market is thinking, but I think Powell continued to reference, in essence, we've set our policy stance. It's unlikely to change all that much, and what we really need. We need one of two things. We need support from fiscal policy. Obviously, the odds of that seem to be coming down, or we need a vaccine. There's still a lot of uncertainty about that. But I think I hear what you're saying. I think the Fed did what they told us they were going to do, and I wasn't really expecting them to do much more.
Michael, I mean, Powell came out and basically said we're going to keep interest rates near zero for the next 3 years. Why isn't that not enough? It used to be enough to hear something like that from the Federal Reserve. Why is it not enough now?
I think so. What I was hearing when I was talking to investors was essentially that the Fed had announced this shift to average inflation targeting. That must mean they're ready to do more. So by kind of surprising markets about the timing of that announcement and actively stating that they need a makeup strategy, I think there was an impression that, well, now the Fed has to do more to achieve that. Where I think the Fed was pretty clear over the summer in saying the framework review is just codifying some of the things or the ways that we're behaving already. So I didn't expect the Fed needed to do a lot more, but maybe there was an expectation that they would.
Michael, isn't the real problem here that the Fed pretty much can't do anything more? And sure, it can pump up the stock market, but that continues to not translate into Main Street America. Small businesses, for example, their businesses have been completely ravaged by the pandemic. Isn't it now up to lawmakers to help jumpstart growth here?
I think that's right. And I think the Fed has said that there are limits to monetary policy. The zero lower bound is a serious constraint for monetary policy. Asset purchases are kind of second best policy tools relative to changes in the interest rate. Monetary policy does have limits. There's not a lot more that the Fed could do other than buy more longer dated assets. Those are only likely to have marginal effects. So I agree with you that the emphasis needs to shift back to fiscal policy and we need medical solutions. The medical solutions appear to be in train, both in terms of a vaccine and better treatments for people who do get sick. And I think the emphasis has to be on fiscal policy, and obviously that will be dependent on election outcomes as well.
What about the recovery you're seeing in the labor market? It seems to have stalled right now. And Jay Powell yesterday saying that the unemployment rate might actually not reflect the huge amounts of Americans who are not even actively looking for work because they wouldn't be included in that unemployment rate. What do you make of that? And what might the real unemployment rate be like right now?
So I think that's right. There's kind of two categories of misclassification. One is essentially has to do with how you're described as being out of work, but the other is this group that falls out of the labor market. If you take both of these groups back together, you're probably looking at an unemployment rate closer to 10%. Let's call it roughly 2 percentage points above where we are presently. So that kind of shadow unemployment rate has been coming down over time, the gap between that and the actual reported U3 unemployment rate. But I do think it's right to think, or to say that the true unemployment rate is higher than U3, the 8-ish number that gets reported. It's probably closer to where that U6 number is. Momentum in the job market does appear to be slowing, just like we're seeing on the activity side of the ledger. And I think these two things are related. If households have less pent-up demand, there'll be less production and therefore less hiring. So things are going to moderate as we go forward. I think the claims data is telling you that too.
It looks like Wall Street's trying to catch up with that reality too. Michael Gapen, Chief U.S. Economist at Barclays, thanks for being with us.
Thanks for having me.